about a month and a half until the deadline to file your taxes. It's April 18th this year.
Yeah, it's like tomorrow, right?
Yeah,
No,
please don't scare me.
There are new tax laws that could impact your return, and to find out how you can maximize your return, even now, we are talking with Timothy Baker, a chartered financial analyst with Metric Financial in Simsbury. Good morning, Tim. Thanks for joining us.
Good morning, guys. Thanks for having me.
Want to get to the 5 top tips because people want to know these. Let's go over the first one.
Sure. So first one, the number one question you hear is, what tax bracket am I in?
Right.
Right, and that gets very confusing for people because everybody assumes they're in one tax bracket, but there's actually multiple tiers. So you're in a blended rate. If you're in a 24% tax bracket, some of your money is taxed at 10, some is taxed at 20, some is taxed at 24. So it's important to work with like a financial advisor or a CPA that can help you figure out what that actual tax bracket is, because it'll help you with planning.
Okay.
And you know, when you're filing too, there's the, you know, if you're married, right? Do you file single, married? That can get really confusing too. What advice would you give to those trying to sift through that?
So that's a really important question for a CPA, because there are different things that would dictate whether you, so if you're married, should we file separately? Should we file jointly? Right, and there are different situations, like if somebody has a public job, they're waiting for forgiveness, or if somebody runs their own business, they might file separately, and that'll impact things like Roth IRA contributions, which I know is one of the other items we were going to talk about.
So continue with your...
So I'll jump into the Roth. So we get a lot of questions about whether or not people can contribute to a Roth. People love them because even though they're after tax now, they're tax-free and you never have to take out of them again. There's no required minimum distributions, but there are limits on how much you can earn. So if you're married filing jointly, you can't make more than $218,000 as a couple. If you're single, you can't make more than $153,000. But little nit that people don't know is if you're married filing separately, you can't make more than $10,000 and contribute to a Roth. And people have to be careful, because if you put money in when you're not allowed to, the IRS finds out, you got to take it out and pay penalties on it.
Pay penalties on it, which nobody wants to do.
No.
That's incredible.
No.
All right.
What about your employer retirement plan? Is that something you should max out on?
Yeah, so we get a lot of questions about there. I'm a big believer in asset location, not just asset allocation. So it's always good putting money away now. Pre-tax is great. You're probably in a higher income tax bracket now than you're going to be in retirement. But you have to think about, what are things going to look like when I retire and take money out? Anything in my retirement plan is going to be taxed as income. Anything that's not in a retirement plan is going to be taxed as capital gains, and those are usually a lower tax rate than your income tax bracket.
Oh, really?
And then like a Roth IRA, you never pay taxes on that again, and you don't ever have to withdraw from it. So we tell people, like, talk to an advisor, talk to a CPA, figure out where you're putting money now, and how it's going to work best when you retire, and it's good to be diversified.
Okay. What about your next tip?
So the near and dear to my heart topic for another day, we get a lot of questions about, I'm getting a 1099 with capital gains from my mutual funds. I didn't sell anything. Why? Right? So it's a very logical question.
Right.
The answer is the structure of mutual funds is such that if you and I own the same mutual fund, I sell my shares, it's going to generate a capital gain for you. That's just the way mutual funds are structured. So we try to let people know there are alternatives. At Metric, we only use exchange-traded funds, or ETFs. Most of the reason for that, in addition to low costs and trading liquidity, is they tend not to distribute capital gains, so it allows the person more control over when and how they're taking capital gains.
Got it.
All right, and tip number 5.
So tip number 5 was, can I take advantage of tax loss harvesting? So hopefully people have an advisor that does this for them. Take a year like 2022, which was not great for the market, but you should be able to sell one thing, buy another, so you're not out of the market. Take a loss on what you sold, use it to offset any gains you have, but it can also be used to offset income. So you can take up to $3,000 a year against income, and you can carry it forward. So if you had $9,000 in losses, you could use $3,000 this year, $3,000 next year, and $3,000 the following year. So it's a good little tool to help lower your tax bill.
That's terrific.
Wow.
In terms of extensions, I mean, what's the last minute you can get in before filing an extension?
Yeah, so usually extensions are go out to October.
Oh, okay.
So I always tell people, be very careful about extensions. If you do them too much,
Yeah, they'll
the
look at
IRS
this,
is going to start wondering why you have to keep filing for
Exactly.
extensions. So
Very good.
I don't think anybody wants an audit.
All right, thanks, Tim. We appreciate
Yeah.
your time.
And really quick, for more information, if people
Yes.
want to ask you some more questions and tips, where do they go?
All of our information is on our website, metricfin.com. And, you know, our phone number's there, education about tax, ETFs, mutual funds, everything. It's a pretty educational site.
Great.
Excellent.
We learned something, so
I
thank you.
certainly did learn
Thanks
something.
for having me.
All right, thanks for being with us. We so appreciate it. Marcy?